From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, January 10th, 2020, and you're listening to the first episode of the new year and the first episode of Season 2 of the HPS Macrocast. I'm Tony Fratto at Hamilton Place Strategies here in the Washington, D.C. studios, along with John Fagan from Markets Policy Partners. Brendan Walsh, I think, is with us from the Quiet Car today. Brendan, say hello. All right. Matt McDonald, my partner here at Hamilton Place Strategies, is with us as he always is on a Jobs Day. It's great that our first episode of season 2 here in 2020 is a Jobs Day. We have the full team here for the HPS Macrocast. So we just did we got the jobs numbers a little while ago. Matt, you want to run down the numbers for us and tee us up?
Yeah. Happy New Year. Happy Jobs Day, everybody. Jobs numbers for today. So the top line number was 145,000 new jobs in December. Unemployment held steady at 3.5%. So those are the headlines, both pretty good. 145 I think it was a little below consensus, not a ton below consensus. It's also right in the zone of how many new workers the economy can produce any month. So it's stable, steady, pretty good. Some of the underlying pieces of it that are worth calling out and notable, on earnings, those are up 2.9% over the last 12 months. So still seeing wage pressure a little bit down from where it was, but still pretty good. The revisions over the previous month were down a smidge. So we had that 266,000 job blockbuster that got revised down to 256, but that's not a huge revision. With the revisions, the 3-month trailing average is 184,000 jobs per month. It's also December we're looking at the December number. So there's kind of the holiday season aspects of it. Retail was up. Interestingly, transportation and warehousing was down a little bit. The retail is different these days, and it'll be interesting to see how those numbers kind of adjust over time. But
BLS does, obviously does its models. It's seasonal, and they estimate, what they expect for any month, and particularly December. But it's a dynamic economy. It's hard to model. Right? It's hard to get those right. So.
The only other nuggets that we've looked at in the past that are worth pointing out is participation held steady at 63.2%. Labor force participation has been a theme of this recovery, and it's good to see that holding up even as kind of workforce ages. The other nugget that BLS had in the release that I thought was notable is that the U6, so the unemployment rate itself is technically referred to as the U3. The U6, which includes people employed part-time for economic reasons, in other words, they would want a full-time job but can't get a full-time job, that declined by 500,000 over the past year, workers who were part-time for economic reasons, which is a nice little nugget late in the recovery that kind of is a good indicator of where we are. So all in all, solid number.
Steady as she goes.
Yeah, another nugget from the Amtrak Quiet Car. Brendan has sent this nugget in. Women hold 50.04% of all non-farm payroll jobs.
I saw
76.2 million compared to 76.1 million jobs for men. It's the first time ever.
I saw that too. I think Betsy Stevenson, excellent, former labor economist and from the Obama administration, noted that on Twitter. It is interesting, right? I didn't think. I still would have guessed that. I would have guessed that the gap was closing. I would not have guessed that it was that close enough for women to become the majority of the workforce.
That would be a fascinating stat to look at the composition of it by age and education and a bunch of other stuff.
Trying to imagine going back in time, even 25 years ago, forget 50 or 75 years ago, and say, 2020, women are going to make up a majority of the workforce, employed Americans, they would say you're crazy, and all the very smart reasons why that's impossible to happen and couldn't happen and would be bad for the country if it did happen, when of course it's great for the country that it happens.
Yeah, it would be interesting to unpack all the narratives and dynamics that would be behind that, and I'll leave that to someone who's better.
It's also me. It's also an interesting nugget thinking about as we've looked at labor force dynamics over the past several decades, is that women entering the labor force in large numbers is one of the kind of, Tyler Cohen would say, like low-hanging fruits of the economy, of where we took advantage of that wasn't previously taken advantage of. And it's kind of like, okay, so we did that. And that's good, but you can't, it's a non-replicable economic trend.
Once you fix
run its course. Yeah.
Right, because obviously just think about it, what had happened when women were not, fully exercising their opportunity to go work in the workforce, is the workforce was deprived of some really smart and talented people, right? If you were only drawing from men, then you were getting on the tail of the tail of men, the ones who were not really smart and talented because you had a preference for men, and you were not getting the women who were on the other end of the tail of the very smart and talented women. So it's great for the economy. It's
also interesting to note that the population at large is a smidge more women than men.
It's a smidge more, and also, but we should note that
it'll be interesting to see if it stabilizes kind of in that.
Well, there are other dynamics going on too, though, because women also have been, ironically, right? So the irony is that they're now, a slightly larger portion of the workforce, but their rate of participation in the workforce has actually declined in recent years, right? So a share of women who are actively pursuing work has gone down. It's off its peak.
Meaning that the share of men has declined more.
The share of men has declined more for whatever reasons.
This is why looking at like age cohorts and stuff would be good to understand.
Yeah, just as an aside on this, I used to look at Japan very closely from an economics and markets perspective, and the demographics there, as we all know, are pretty severe, very severe aging. And talking about revitalizing the workforce, the great Kathy Matsui at Goldman Sachs had her thesis about womenomics, which is bringing more Japanese women into the workforce and the revitalizing aspects that's brought in, the new economic ideas, the new parts of the new kinds of businesses that they've brought together. It's a really interesting development. It's continued. I'll have to go back and take a look at the latest data on it.
Japan is. We could do a lot on Japan, and this really complicated relationship they have with women in the workforce, professional women. It's a hard place. It's a hard place for women to work, but they still are. They are going to work. But, of course, everyone is worried about the demographics, and, they're going to work, but not, staying home and making babies.
Yeah.
And
right.
which is exacerbating their, right, just observationally making it difficult for them to replace workers in the workforce.
In broad brushstrokes, looking at Japan is just an endlessly fascinating thing from an economics and markets perspective. So many of the things that have transpired in Japan over the last few decades, Western-based investors traditionally used to look at those and say, well, that is an absolutely unsustainable policy. And then flash forward 10 years when we were doing the same thing.
Yeah.
Going to Japan has always been like going to vaguely the future, but not really. And that's consistent with that experience.
And certainly just to circle it right back to the labor force, they had Japan was one of the places where you first saw the phenomenon of exceptionally low unemployment rates not feeding through into rising wages and the traditional wage price spiral that classical economics always centered around when thinking about how price pressures build up in an economy. And it was always a conundrum that was considered, well, Japan's different. Well, maybe it's not so different.
No, it's true. And I remember in graduate school and afterwards everyone trying to unpack that. There was a belief for a long time that it had to do with the very large bubble, right? So asset prices, all real estate and others, increased, enormously. And so, there wasn't the additional wage pressure, inflation, wage push inflation, because you had this, it was already overpriced in for a long time.
Yeah.
But that was, more than 2 decades ago, right?
Right.
It's still, we're still not seeing
And this report this morning, as Matt said, features, softer, another solid number, and still okay, but certainly no evidence of wages running up. And so from the market's perspective, this is another Goldilocks number.
Yep.
Reflects a consistently strong, robust labor market, which is underpinning the strong U.S. consumer that is baked into everybody's expectations about the economy this year. And it's also validating what Fed officials have been talking about for months, and they really predicated their rate cut cycle on this low and persistently low price pressures thesis. And so it's right down the fairway in terms of markets. We saw a little bit of a shimmy in the S&P 500 futures and Treasury yields in the dollar, but most of those washed out very quickly. The bar was very high for this number to be a big, huge market mover, both on the upside and the downside.
And look, it seems like throwing off this market is impossible to do right now. Like, you have to admit, it's hard to come up with what's the data point that would do that. It's on a tear. It has been for a while. It's starting off the year on a tear. We're going to see Dow 30,000 at some point. We'll talk about it on this show. Hopefully it'll happen while we're recording. That would be great and fun. But look, that's where we're heading, right? Dow 30,000. Markets this morning, you're right. Like, it's muted, but steady again, like steady as she goes. There's no reason to step away from equities. It furthers the expectation, which I'm going to come back in our next segment, talk a little bit about the Fed. But steady as she goes at the Fed too. So here we go, like starting off the year on a good start.
Yes, with the geopolitical risk kicker that we'll get to later in the show.
We'll talk about geopolitical risk too, and see whether anything matters anymore. We just we don't really know. So there's enough out there. Why don't we take our break there? We'll come back and talk about the Fed and geopolitical risk and other things. You're listening to the HPS Macrocast.
Hamilton Place Strategies is an analytical public affairs firm based in Washington, D.C. Learn more at hamiltonplacestrategies.com or follow us on Twitter at HPS Insight.
Okay, and we're back with the HPS Macrocast. We had a lot of macro talk in the last week, a lot of Fed speak at the American Economic Association conference. We had Fed speakers out. We are steady as she go. We got no indication that things would have much of a change. And people, it seems like everyone's talking from the same song sheet, John. But was there any nuance in there we should be paying attention to?
Yeah, you're absolutely right, Tony. It's been very consistent. The Fed has gotten their messaging pretty much set in stone here in a wait-and-see policy posture, a cautious wait-and-see policy posture. The understanding from the markets and what has been conveyed by Fed officials really is that skewed toward more action if necessary, and basically saying that rate hikes are so far over the horizon. And it was Chair Powell who characterized only a very significant increase in inflation would kick rate hikes into gear again, and nobody really is putting that.
And what does that even mean? What is a significant increase in?
Well, they're certainly not exactly explicit about it. The Fed uses constructive ambiguity on these points. The target of the core personal consumption expenditures price index, we're a mouthful there, but core PCE, which is the Fed's preferred inflation metric, although they've got CPI and consumer price inflation, other metrics, they use that core PCE primarily as their target. They're targeting 2%. I think the last reading was 1.6%. So it's not where they want it to be. And the last time, the last time it was up at 2%. Brendan would have that on his fingertips, but but I don't. It's a long time ago.
He would love to tell us right now.
Yes, that's right.
But quiet car rules.
But the reality is, even 2%. the Fed's messaging has suggested that they would be happy to see it go above their target for a period of time. This idea of letting things run a little bit hot, and that's exactly what St. Louis Fed President Bullard said he said, "Bring it on,
exactly
higher than target inflation," and so the bias there, the skew there is really clear from the Fed.
Of course, but again, so we're saying that to knock the Fed off its steady state, we would need to see something that is like a shock on inflation. But again, would it have to have a 3 handle over some period of time? I mean, because if it's 2, 3, which would be amazing, by the way, rarely achievable,
right?
That can't be it.
Right. Well, so much of what the inflation number is all about in terms of Fed is what created that 3%. If it's a big, oil price spike that is fueling that is considered deflationary by most Fed economists, and they wouldn't presumably be hiking rates into a big oil price spike. We'll talk a little about oil price and the potential for spiking later when we talk about U.S.-Iran. But that is a situation where they would probably hold their fire and characterize it as a passing, a temporary phenomenon, and certainly to be dulled later by the longer term deflationary impact of higher oil prices. So the Fed is pretty much put their in terms of rate policy, really put their line in the it's quite clear the line that they've got, which is biased toward doing more cuts if they absolutely need to. And in fact, futures markets put pretty reasonable odds of at least one more rate cut over the next year. Now that's kind of, low conviction sort of price action, and behind those bets, it's certainly not a consensus forecast, but there's, it's pretty clearly understood that this Fed is got its finger on the button to do more. The big change in Fed policy in 2020 that most market participants that we talk to are focused on is the potential for them to basically stop the balance sheet expansion that they reinitiated in the fourth quarter of last year, in October of last year, and that's going at a clip of $60 billion per month, roughly, which is a big number. And it was, as we've discussed on this on our podcast a number of times, designated as a technical adjustment to reliquefy the front end funding markets. It's not quantitative easing. It's not designed to do the things that quantitative easing is supposed to do, which is ease financial conditions, lift, broadly ease financial conditions, lift asset prices, so on and so forth. But it's a little bit kind of hair splitting.
Let me ask on the question of the inflation tolerance side of the stuff, is that it sounds like the Fed is in the position where they would tolerate significantly higher inflation, but it doesn't sound like they're in a mode of trying to cause significantly higher inflation. Is that a fair balance of what the market thinks their position is on this stuff?
Well, Vice Chair Clarida characterized their policy settings as being supportive of rising inflation, supportive of inflation rising to their 2%
cheering
target.
Or trying to cause. That's
right. They believe that the 3 rate cuts that they put in place plus the
given time.
Yes, given time will prove supportive. And so they're watching it play through. And this is the expectation.
Do the markets think that I think will bear out?
I think the markets have thought, I'm interested in John's thoughts on this, right? But I think the markets have thought that whenever the Fed, and language matters so much, whenever the Fed talks about being data dependent and that there was a hair trigger on reversing at the first sign of inflation. And I think what they're very clearly trying to signal right now to the market is we've taken our hand, not only have we taken our hand off the trigger, we've put the safe on, right? We've got a safe on. There is no hair trigger. We're willing to let this run for.
When they talk about data dependency now, I always hear data dependency on growth, not data dependency on inflation. Like they want to keep it going.
Right, but it really has. The Fed has narrowed the data points that they have referenced during this loosening cycle because so many of the other, because labor markets really looked pretty good. There may be an element of cherry picking here. They focused in laser-like on the core PCE because that was one of the few dials on the dashboard that was telling them it's, a good idea to start cutting. Now, I'm not saying that they're intellectually dishonest about this. Clearly, those PCE numbers were what they were, and if the idea is that if tight labor markets aren't doing what we think they should do in terms of rising wages, then maybe they're not as tight as we think they are, which means the neutral rate of unemployment is much lower, and we're kind of groping our way in the dark as policymakers toward this. Now, when you look at markets, whether it's the sort of market-based gauges of inflation expectations, the 10-year break-evens, the 5-year inflation swaps, none of those, they're up off their lows, but none of them are at 2%. They're around like 1.8. And so that's basically saying that the Fed has, that's kind of a soft landing expectation for inflation. And certainly it doesn't, it's not total consensus on this. And there's certainly those betting on a more inflationary. In fact, it's kind of a cool, to bet on among hedge fund types to bet on a reflationary impulse. But that's not where the mainstream
one of the things that Rich Clarida, Fed Governor Rich Clarida, brought up in his interview was this sense of, and it's relevant today with seeing the jobs numbers, is the sort of sense of being humble about workforce participation, being able to draw in workers off the sidelines. That essentially saying, the committee didn't anticipate really how much slack there was available to draw in. And of course, economic historians will be studying this for a long time, and demographers and others. So just why that's the case. I think it's not. I'm not faulting the FOMC. I think it surprised everybody of how much room there was to grow there. But did we get anything on workforce participation? I didn't even look at the participation.
Participation rates steady, and then we talked a little bit about U5, U6 going down over time. So all that stuff is good. I mean, I think to your point on that, Tony, I think the problem for economists in the moment is that you have two dynamics at work. Is that you have a very over the past 10 years, you have a very slow recovery in terms of the labor market being kind of sticky and more U-shaped than V-shaped. And the other dynamic is that you have this kind of historical movement of the baby boom generation out of the economy at the same time. So it's really hard to kind of decouple those and understand both which is the dynamic you're seeing. If you're seeing like a drop in labor force participation, is that because people can't get jobs, or is that because like people are done working? Or do you have dynamics of like moving to a service sector economy where it's like you don't,
or it's the people who don't have the skills.
And then you have behavioral changes, like a lot of the baby boom generation has a different self-conception of retirement and when they're going to, there's just so many different dynamics at work. It's hard to pinpoint some of those.
And former Fed Chair Yellen at the American Economic Association's gathering this past week referenced this conundrum that the Fed has encountered, which is if they're using policy vigorously to try to boost inflation and to try to get to full employment, they, and these are tamped down or changed by the structural fundamentals, the demographics, very key among them. They can that will lead them to overly loose policies that can lead to financial, basically financial trouble down the road. And so Janet Yellen has been, she referenced the need for really, heightened macroprudential regulations and strictures on risk taking and that sort of stuff to keep those financial excesses in place while the Fed is trying so hard to achieve its goals in the real economy. Yeah. It's a tight rope to walk, and we had a lot of very interesting commentary and a lot of high profile disagreements out of that gathering this week.
It really is an important moment for just contradictory thinking and really pressure testing assumptions and having a lot of different mental models on the table, because it's not clear how this story goes over the next decade.
That's absolutely right. Yeah, and basically taking a look at the sort of Bernanke versus Summers, toe to toe heavyweight economist bout that occurred over the efficacy of monetary policy to carry the load in the next downturn in terms of cushioning a recession.
Only one can remain.
The Thunderdome
battle royale, cage match.
Two economists enter.
All right, let's take our last break. We'll be back. You're listening to the HPS Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, back on the Macrocast. So we did have some geopolitical events over the past week. There were market impacts. As the United States took out a really bad guy named Qasem Soleimani from Iran. Everyone's aware of this. On I don't know. I'm not going to get into the legalities of it. We're not going to talk here about the legal aspects or the political aspects, just the economic aspects and the macro market aspects. The Iranians responded with some missile attacks on some of our bases in Iraq. And there was some initial market reaction, some initial pricing reaction in oil. But overall, really muted. I think that, there are reasons for that. The president wanted to talk about, how we're essentially oil independent. So we don't have to pay attention so much to the Middle East. Now we should remember these are global markets, and the global disruptions still really matter. And we have businesses over there and in the markets, and so their bottom lines are impacted by these kinds of events. It's not just that we're oil independent though, because we're producing because of the fracking and the shale boom, and we also use a lot less. I mean, people, look, if you're my age, you still, remember the oil shocks of the 70s. You have some recollection of cars lining up on alternate days, depending on your license plate. At that time, oil was a much bigger part of U.S. GDP. We used so much more. It was a bigger share of GDP. A global shock could have an impact. Today, it's a much smaller share. We're much more oil efficient. And it's a much smaller share of GDP. So we don't have that same kind of disruption, in addition to the fact that we also produce a whole lot more domestically than we ever have before, and in fact, we're in a position to export. So, John, what did we see in the market? What were they thinking when they saw this?
Well, first of all, it was considered by markets. Geopolitics is very difficult for markets to price in these low probability but potentially enormous impact events. Very often, investors they can't get ahead of it. Markets try to be forward looking and discount risks, but risks like this, of this magnitude and of this, high level of uncertainty and so many different considerations well outside the expertise of most market participants, they tend to basically default to a pretty reactive posture. Mm-hmm. But we did see, we saw some pretty modest moves. We saw the S&P 500 down, it was down about 2% when the Iranians responded with the missile strikes. There was a lot of false reporting out there. There was an enormous amount of uncertainty. The sort of fog of it. Were there U.S. casualties and were hostilities expanding beyond this missile strike, so on and so forth. And 2% down is not great, but it's hardly disorderly. These were pretty modest moves, and this came after Friday when the S&P, the day after the Soleimani killing, the S&P wasn't even down 1%. Yeah. So it's very difficult. There was demand for safe haven assets, but once the dust settled on Tuesday night, President Trump canceled a press conference. There were reports that there were no U.S. casualties. The Iranian missile strike appeared to be orchestrated in a way to minimize the risk of casualties, whether pre-warning and so on and so forth. It's still, pretty major event. But the the rhetoric around it from Tehran was de-escalatory in nature. And markets breathed a sigh of relief on Wednesday morning when the president came out and announced tightened sanctions but no further military action. This was now mutual de-escalation, and markets basically reverted to the status quo ante. And this was in treasuries, in S&P 500 immediately lurched to a new record high and went, back to, as you were. Gold retained some of its gains, and the situation is still pretty fluid. And our global security expert associates at the Hawkwood Group are monitoring very carefully the risk. And the risk really is here that the red line is clearly American fatalities. Yeah. And, when you're lobbing missiles around, even if you make preparations, you can't be sure of anything. And certainly Iran has lots of empowered proxies that can freelance, and they can cross some of these red lines potentially without the say-so of Tehran. And that's the scary part of it. And so I think markets are very happy that the initial sort of crisis phase is past, and we've gone back to a fragile, the typical sort of Middle East fragile peace, fragile equilibrium.
The weird thing about this episode is that the actual retaliation against the U.S. almost seems nominal, but the accidental downing of a civilian aircraft full of Ukrainian and Canadian nationals, it feels like that's the biggest aftermath and outcome of this stuff, which is just to your point on the inability to predict where some of these things go. You don't know, and that's a weird. It's not, I think, what people were expecting.
Yeah, not at all. And by the way, just bringing Ukraine into this another story is bizarre in itself. So nothing was solved really, right? This was an episode. Iran and the United States won't be sitting down to the table to negotiate a nuclear agreement. Probably put off the likelihood of a nuclear agreement longer. Probably. Iran will double down on some of its things, like the nuclear program, as it indicated, it's not going to be bound by some previous restrictions. And I would not be surprised if it's doubling down on its support for Hezbollah and some of these other groups. So it'll be back. I just think from a market standpoint, I think muted is the most likely outcome. If oil is the commodity that you're worried about, there are other reasons why you can be upset about it. If oil is the thing that you're worried about and knocking off this expansion and growth, it's probably not going to come from these kinds of episodes.
Yeah, absolutely right. I mean, the way that the oil price dynamics have changed, it's really taken the queen off Iran's chessboard in a lot of ways.
Yep, exactly. All right, guys. What do we got next week? We got data coming next week?
Next week, earnings season starts up, fourth quarter earnings. It kicks off with the banks, JP Morgan, Citi, Goldman, so on and so forth, and that's going to be quite exciting. Better than expected earnings was a major upside support for equities last year, and we'll see if that year closed out in the same vein. We've also got U.S. December retail sales, industrial production retail sales is going to be the big one, and China's fourth quarter GDP numbers. So we'll have some data and earnings and some excitement.
China's going to come in at 6%, right? I mean 6%?
6.0.
6.0. All right, guys. Happy New Year. And thank you, listeners. Looking forward to a fun Macrocast year.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.